Hello and very warm welcome to this edition of the Mutual Fund Eye. My name is Vandita Shubhle and I'm here to take a very interesting question today. Well, the weather is really looking beautiful and the question is also very good. So what's the question? The question is, how do I select the debt fund, the right debt fund? What should be the strategy behind it? Almost 5 people have asked me this question, so I thought, why not to make a short video on that, right? See, there are a couple of things here. Firstly, asset allocation. I have always emphasized on one thing, that how you should be creating your portfolio. What kind of asset classes you should be investing in. See, there are different asset classes. You have equity class, you have debt class, you have cash, you have real estate, various other asset classes where you could invest. Now it's your choice, depending upon your goals, your risk appetite, how much corpus you have, you create a portfolio, right? But the most important thing over is, whenever you create a portfolio, is the right balance, and you can always do that by investing in different asset classes. Equity category is for the growth, right? If you want to grow your portfolio, you need to have certain investment in equity, right? In that class. When you're looking for debt, right, debt is also a very important class, and people are not understanding one thing. In order to give that kind of support to your portfolio, in order to give that kind of stability to that portfolio, debt is a very important asset class. It plays an important part. Now, why there's a mystery behind this debt asset class is because people do not know how to invest in this asset class, and I think that's the question here. Now, before you invest in debt funds, right, I'm not saying in mutual funds alone. I'll tell you why you should be investing in debt funds via mutual funds. Because understanding the kind of risk that comes with debt funds is more important than investing in debt funds, right? Why? I'll tell you why. There are two kinds of risks that are involved when you invest in debt fund. What happens when you invest in debt? It is basically that the issuer or the person who borrows the money or the company that borrows the money, they are basically obligated to pay the lender certain fixed interest payment. It's also called coupon, right? So that is defined, and then when it gets matured, the principal is returned as well. That's the entire scenario when you invest in a debt fund. Now what happens is, what is the risk involved in it? When you give someone the money, the first risk that is involved is whether I will get that money back or not, whether that person defaults or not, right? So that is a very important risk that people miss, and that is called credit risk. In order to avoid that risk, what one should do is, either they can invest in government securities, because that's almost risk free. I would not say completely, but still I would say that's almost risk free, or high credit rated paper, high credit rating, the companies or the papers which has got higher credit rating, right? It's very important that you do not invest in low grade papers. So that is an important part when it comes to credit risk. Second risk that's involved with regards to debt fund is the interest rate risk, right? See, every time people only think of maximizing their returns, but in order to do so, they forget there's a credit risk involved, right? So what is interest rate risk? That is nothing but it keeps changing with the economic activity of the country. Why? Because if I'm getting 10% on a particular paper, maybe there's another person and he's getting 12% kind of interest rate, but that is something which is fixed, right? And you will get only that amount. So that kind of risk is also involved when it comes to debt. So longer the duration, longer the more the interest rate risk. So these two risks are very important. How do we balance it? Sometimes it's very difficult, but still there are ways to balance it. Mutual fund is a beautiful instrument. I've always, told that to all my investors. Why? Because you can diversify the risk. You can diversify the interest rate risk. You can diversify this by investing in debt papers. debt funds. Why? Because these debt funds are a collection of debt papers. These debt papers and the fund manager plays a very important role here. He is managing that kind of paper, and he watches and makes sure that your interest rate risk is reduced, your credit rate risk is reduced. Now, as an investor, we should also be aware, while we are investing in this, there's a scheme information document provided to everyone. Whenever you invest in or you take up any mutual fund, it's available. You have to look at the kind of papers that the debt fund is investing in. They should be highly graded papers. They should not be low grade papers, because then the risk is more prominent. And I don't think in such a scenario, when a lot of things have happened, in any scenario, I would say, I would always suggest look at good rating agencies, like you have CRISIL, you have ICRA, you have Fitch. Look at those ratings. They should be AAA rated papers, so that you can minimize your risk. In order to minimize your risk, you should also look for investments in, because we know that most of these debt instruments, they invest in secure treasury bills, in GSECs, in various other different kind of securities, in commercial papers, in certificates of deposits. Now, these commercial papers, are these listed, commercial papers, they are issued by companies. Certificate of deposits are issued by banks. So those kind of things you should always look into, because it's very easy to read an equity fund scheme information document, but it's very complicated when it comes to a debt fund. Not everyone is aware of that. So definitely you need a good advisor when it comes to selecting the debt funds according to your risk appetite. A person who says that I am ready to take all kind of risks, okay, I am ready to take high risk, for them credit risk they can take, right? But for a person who is not ready to take any kind of risk, they are risk averse investors, then what do they do in such a scenario? You should always invest in short duration, so that short duration papers or funds, so that you can avoid that kind of risk. I would not say avoid, but minimize that kind of interest rate risk. And you should invest in high grade papers to minimize the credit risk. Okay, so this is a very important point here. Understand your risk, right? Until and unless you understand your risk, you might lose money, right? And that's what happens with most of the investors. They're not willing to take risk, but still they invest in something thinking that I would get more returns. Of course, the person who's ready to take more risk will be rewarded more than a person who's not willing to take that kind of risk. But then the risk is a risk, right? One should not take too much risk as well, because that's going to impact overall portfolio. Yes, if you have so much of extra money, then it's your choice completely. But still, according to me, you should be a little more careful. Then choosing the category of fund is also very important. Now, in debt funds, when it comes to mutual funds, in debt category, you have ample of categories. You have again plethora of options. You have dynamic bond funds, you have money market instruments, you have overnight funds, you have liquid funds. Which category you should stay with? If you ask me, liquid funds would be an ideal choice for an investor who has some idle cash and who's not willing to take that kind of risk. Why? Because liquid funds, the tenor is less, the duration is not so long, so the interest rate risk is not much. The credit risk also gets lower if you are investing, if you're looking, into the if you look at the high graded papers in that context. Also, if you see, one thing about liquid funds which is very good is that they invest in only listed commercial papers, which is a very, very important point. SEBI, this is one of the norm provided by SEBI to the mutual fund association, that they need to take care of this. Whenever you are investing in liquid funds, it has to be in listed commercial papers. So that is another thing. Next important thing is that they do not invest more than 20% in any one particular sector. So again, you are diversifying, and see, the more you diversify, the lesser risk you are taking. It's very important, and that is the whole point why you invest in mutual funds, and a lot of people forget that fact. Now I would say that you can invest in liquid funds. That's a very wise choice. Another thing that you will notice is dynamic bond fund is a very good category. Yes, sometimes a lot of people say that it is helping in minimizing the interest rate risk and maximizing the return, but it might have credit risk. Yes, credit risk will always be there, but be very careful where you are investing, right? What papers you are investing. They should be highly graded papers, and look for government securities. If they have more of government securities, it's more secure, so look for those kind of funds as well. I would say that that's why gilt funds, get famous, and why a lot of conservative investors prefer that. That's the reason. They don't care how much returns they are getting. I mean, it's not about caring, but they're okay with lesser returns, but they're not ready to take that kind of risk. And that is why, please understand your risk appetite and only then move forward. Even in equity category, I have always told people, if you're not willing to take that kind of risk, why to invest in mid caps, why to invest in small caps, when you have blue chips, when you have a large cap category, when you have focused equity categories, so many other categories. You have multi caps also, which can diversify your portfolio in the right way. They're focused equity funds which are doing amazingly well even in these times. There are a lot of focused equity funds which are doing in the multi-cap category, which are doing well. These are focused funds. They do not invest in funds. They target AUMs, they target larger AUMs, right? Assets under management. The more money they have, the larger AUM, more the liquidity. And please remember that whenever you are even with the debt fund. So that is my only advice to all the people who want to go for debt funds. Please stay with short duration and high graded papers. That's how you can minimize the risk when it comes to debt funds. And mutual funds are a very good instrument. Why? Because see, what happens is in mutual fund, there are various categories. Even in dynamic bond fund that I've told, when is it risky? Dynamic bond funds are riskier when the interest rate scenario is rising, right? When there's higher interest rate scenario. But right now, if you see, even the repo rates going down, the economic activity is going down, and there are a lot of surveys done by various agencies where they're telling that we'll see a contraction in the revenues of various companies, and these are the larger companies that we are talking about. So we all know that this is a time when these companies, their results won't be great, so the revenues will go down, so definitely there are chances of defaults. So as an investor or as an advisor, it is my duty to understand that there is a risk involved, and I need to make sure that the credit risk should be minimum. So I will invest in safe, safe instruments and safe papers. So that's how you can maximize your returns. Look at the demand and supply scenario. Look at these kind of attributes whenever you are looking at debt funds. So that's my advice to you. I have a very, very interesting another question that's from Safiullah. He wants to understand the difference between small finance bank and national bank. So I'll take up this question tomorrow or maybe on Monday. But I think that's how you should be looking at when it comes to funds. A lot of mutual funds, mutual fund houses and AMCs are now looking to expand. They are looking, to take benefit from the lower valuations that are, that we are witnessing right now. So, for example, Mahindra Mutual Fund, Mirae Asset Management Fund, Mirae Asset Management Company. So they are really looking for new stuff and new funds. So let's see what they come up with. I'll keep you updated with all that, and all the very best with your investments. On that note, have a very safe stay at your home. Bye bye.